Yeah. Okay. So anyway, so I'm going to start with tomorrow. Today, we're going to start talking about the institutional setup of the Federal Reserve System, central banking and the Federal Reserve System. And then we shall delve deeper into money creation process and stuff like that, monetary policy. But today, there's going to be no math, but it's a very fascinating chapter. Basically, it talks about the institutional setup of the Federal Reserve System, because the Fed is one of the biggest bureaucracy of government agents that controls the supply of dollars and interest rates. So there are different sub-agencies of the Fed, different parts of the Federal Reserve that we want to discuss today and what their functions are. So anyway, we're going to kickstart stuff here. So this chapter is going to consider the structure and activities of central banks, focusing primarily on the Federal Reserve System of the United States. So we're going to have a few learning objectives here. We're going to recognize the historical context of the development of the Federal Reserve System. What you're going to learn here is that the United States Federal Reserve is not the oldest Federal Reserve in the world. Actually, the Fed was created way late in the game. The U.S. Central Bank was created in 1913 through an act of Congress, meaning that before 1913, we did not have a central bank. Okay, if you compare this with the Bank of England, the Bank of England was created like in 1694, 1694. That is way many, maybe a couple of centuries ago. You know what I mean? When you think about it. So, we're going to contrast and compare the structures of the Fed and some of the other central banks out there. So then we're going to describe the key features and function of the Federal Reserve System. We're also going to assess the degree of independence of the Federal Reserve. So just like the way we normally treat the other three branches of government, the executive, the legislature, and the judiciary, we also want an independent central bank free from political interference. So we'll talk about the issue, how independent should we want our central bank to be, so that politicians don't meddle with what the Fed is doing. Then we're going to identify the ways in which the theory of bureaucratic behavior can help explain Federal Reserve action. We may skip this because this requires a little bit of knowledge of public policy, but we'll see what best we can talk about the theory of bureaucratic behavior. And then we are going to summarize the arguments for and against an independent central bank. Why do we want to make the Fed independent? What are the pros and cons? And then we shall identify the similarities and distinctions in structure and independence between the European Central Bank and the Federal Reserve. Okay, the ECB, or the European Central Bank, is one of the newest central banks out there. It was created in 1999 when a group of European countries decide that they're going to adopt a common currency. So again, if you go to Europe right now, you go to places like France, Portugal, Italy, Germany, France, Switzerland, all those countries use a common currency called the euro. But before 1999, each country in Europe had their own currency. And then the other thing that we're going to talk about, which is critical, a lot of times people confuse the euro as a currency and the European Union. So being a member of the European Union does not guarantee that you're going to be a member of the European currency zone. In fact, we have 27 countries. It used to be 28 before Britain exited the European Union. Out of the 27 remaining EU countries, only 17 of those 27 countries use this currency. The other 10, they don't. Okay? Like countries like the Czech Republic don't use, they're part of the European Union, but they're not part of the members of the European currency zone. Countries like Sweden, so we'll talk about that. Okay. So let's kind of start talking about the origins of the Federal Reserve System. There's a little bit of historical context here. Okay. So America was formed on a free market, as a free market society, right? Capitalism, where we allow the private sector to take hold of the economy for the most part with limited government. That's how the founding of the nation started. Even when we gained independence from the Declaration of Independence from the British in 1776 onwards, the economy was built, the country was built on this premise of a free market society. Okay, which is different from what happened like in the former Soviet Union. They're more like a central planning economy or socialism. Okay, so we are more like a free market. So anytime you tell Americans that you are going to start another government entity or a government agency in Washington, D.C. People resist that. That is always, because Americans don't want us to be creating several governmental agencies that can control their lives. They don't want too much of centralization of power. So in the very beginning, Americans resisted the idea of central banking. They thought, oh, this is going to be another government bureaucracy in Washington, D.C., which is going to control our life, because they feared the idea of centralization of power, too much centralization of power in D.C., and then also distrust of money interest. They didn't want a government agency that would control their money and their interest rates. Okay, so there was heavy resistance. So that means before 1913, okay. But if you go back in history, you go back in like in 1840s, 1850s, we used to have some bank. The government, Congress, started what they call the First National Bank of America. That bank was supposed to provide some regulatory authority over private banks in the United States. You know what I mean? Regulate other private banks. But the Congress formed it, and they lasted. First National Bank of America lasted for about 4 years, and then President Andrew Jackson vetoed a bill that was supposed to renew the second phase of that First National Bank of America. So once that bill was vetoed by President Andrew Jackson, from that time up to 1913, we never had a central bank. We never had any government agency which was supposed to regulate private banks out there or financial institutions. So that means for a long time, because the main role of a central bank, we saw a little bit in chapter 8, is to provide the lender of the last resort. Okay, that if banks are having liquidity problems in the country, and they don't have anywhere to find loans or something like that, the last place they go to is the Federal Reserve. So if the Fed gives is a lender of the last resort. Okay, so that means the U.S. did not have any entity, any government entity that would provide this critical role as a lender of the last resort. So that means if you don't have a central bank, which would regulate private banks out there, what did we see happen in the United States? Because private banks are going to screw up from time to time because there's nobody providing regulation to them. So we would see nationwide bank panics on a regular basis. Banks would make mistakes, they give out bad loans, and then they would go and then they go bankrupt. Then people are going to have like a run on the bank because banks are closing down. Okay, so with the worst bank panic happened in 1907, where so many banks in America went bankrupt, and so many Americans lost their life savings. Keep in mind that in 1907, we did not have the FDIC, which we have today. FDIC was created in 1934 when FDR became president. FDIC stands for Federal Deposit Insurance Corporation. This notion that if your bank were to fail, the federal government would have insured your deposits up to $250,000 on individual account. We did not have that. So when the banks were failing, that means Americans would lose almost all their life savings. So the worst financial crisis, the worst bank panic, happened in 1907. So when Americans lost most of their life savings, that's when the debate was revigorated in Congress. And maybe we need a government body that would kind of try to provide some regulation on these private banks so that they don't screw up from time to time. But Congress is always divided, like you see the polarization that we have been up to today. So it took a while before the Democrats and the Republicans would strike a deal. So the debate lasted, can you believe, from 1907. Then in 1913, finally, Congress basically passed what they call the Federal Reserve Act, an act of Congress that created the Federal Reserve System, that created the U.S. Central Bank, the Federal Reserve. Okay? So the Federal Reserve created in 1913 was created with an elaborate system of checks and balances. And one of the brilliance of the writers of the Federal Reserve Act of 1913, those congressmen and women who created the Federal Reserve Act and passed the legislation to create the U.S. Central Bank, the Federal Reserve System, they were very wise because they knew that even though Americans were now talking about we need a central bank, there was still a good section of American population that did not like the idea of central banking. So when they formed the U.S. central bank, they didn't form it on a decentralized system like other central banks of other countries we see. They formed them on a decentralized system. What do I mean by on a centralized system? They created it in a decentralized system that because Americans hated the idea of centralization of power in Washington, D.C. So when they created the Fed, they made sure that the branches of the Fed, I'm going to show you the jurisdiction of those branches of the Federal Reserve, what we call the Federal Reserve districts. They were spread all over the countries, branches of the Fed through decentralization. So if say an American hated the idea of centralization of power in Washington, D.C., if you wake up one morning and you see a branch of the Federal Reserve in your district, okay, maybe say in Kansas City or in Dallas, because that's where or in Boston or in Kansas City or in Chicago, because those are places where we have branches of the Federal Reserve. At least that would put a smile on your face that, oh, there's a branch of the Federal Reserve in my district. Maybe that's a sign that our views are being represented in monetary policy deliberations. So that would kind of bring some kind of assurance on the faces of Americans that, perhaps the government is representing their views. So the Fed was created through a decentralized system as opposed to centralization of power in DC. If you compare the decentralized nature of the U.S. central bank, the Federal Reserve, is quite unique when you compare it with other central banks. You go to like the Bank of England, you might find the main branches in what? In London, the Bank of England. But then you have maybe 1 or 2, 3, 4 branches. That's it, all over England, all over, that's it. You go to Germany, the former central bank of Germany, we call the German Bundesbank. You find the headquarters in Berlin, maybe a few other offices, like maybe in Munich and other places in Germany, and that's it. Okay, so but the United States Central Bank has got branches all over. There are 12 district branches all spread throughout the country. So we'll talk a lot about that. Okay. So so the writers of the Federal Reserve, why did they create the Federal Reserve through a decentralized system instead of centralizing just maybe only having one branch in Washington, D.C.? So the writers of the Federal Reserve Act in Congress wanted to diffuse power along regional lines between the private sector and the government and among bankers, business people, and the public. So, and that's going to be another unique feature of the U.S. Central Bank, that all the regional district branches of the Fed, what we're going to call the regional district branches of the Fed, you can call them the Federal Reserve banks. Okay, there are 12 of them, 12 regional, 12 regional banks. These 12 regional banks are not fully owned by what? By government. The Federal Reserve is part what? Part government and part public and part private. Okay, so all private banks in the United States are members of the what? Of the Federal Reserve systems in the district where they're what? They're located. They're members of the Federal Reserve district branches in the district where they are. Okay, so that kind of brings some assurance that it's not a completely government thing, because we attract the private sector, banks and others, business people and the public, when we created these branches of the Federal Reserve. Okay, so I'm going to start talking about the structure of the Federal Reserve System. And by the way, I have to tell you guys, that's a good place to work in. They have great benefits. If you ever get a job, or an internship with the Federal Reserve, one of my students, my master's student, got an internship with the Federal Reserve. He's working this summer in New York, the Federal Reserve Bank of New York, which is a branch of the Fed. Very lucrative, very nice. So let's talk about the structure of the Federal Reserve System. The Fed is a very complex governmental organization or entity, right? So the initial diffusion of power has resulted in the evolution of the Federal Reserve System to include the following entities. We're going to talk about the Federal Reserve banks. These are the 12 district branches of the Fed. There are 12 of them. 12 district banks. Okay, or you can call them 12 district branches of the Fed, all spread across the country. And then we're going to have the Board of Governors of the Federal Reserve System. So there are 7 Board of Governors of the Federal Reserve System. They sit in the headquarters of the Federal Reserve in Washington, D.C. Those 7 Board of Governors of the Federal Reserve are appointed by the President of the United States and confirmed by the Senate. Each of them serve like a 14-year non-renewable term. I'm going to talk about that. So the 7 board of governors. And among the 7 board of governors, the president of the United States is going to appoint the what? The chair of the Federal Reserve. Okay, the current chair of the Federal Reserve is Jeremy Powell. So among the 7 board of governors, DC, one of them is going to be designated to be the chair of the Federal Reserve System. So the chair of the Federal Reserve is going to be doubles as the chair of the board of governors and the chair of this committee that I'm going to be talking about later, the Federal Open Market Committee. So the Federal Open Market Committee, or the FOMC, is perhaps one of the most important entities of the Fed. It consists of 12 members. Okay, it consists of the 7 board of governors who sit in Washington, D.C., plus 5 other presidents of the Federal Reserve banks, and all these 12 district branches across the country. Each of them is headed by what? A president. So, 5 of them serve on a rotating basis of 1 year, with the exception of the president of the Federal Reserve Bank of New York has got permanent representation on that committee. But the other 4 of the 5 presidents serve on a rotating basis of 1 year. So we'll talk about what the role of the FOMC. This is a committee that meets every 1.5 months. They meet about 8 times in a year to decide whether the United States, whether the Federal Reserve needs to increase, decrease interest rates, or let interest rates stay the same, or decide whether to increase the money supply or decrease the money supply. So we'll talk a lot about what they do, their function. And then we're going to have the Federal Advisory Council. So the Federal Advisory Council is basically, there are 12 of them. So each of the 12 district branches of the Federal Reserve, they're going to appoint like an advisory council, which acts as a go-between each district branch and the board of governors in Washington, D.C. That's what the advisory council members do. There are 12 of them, each representing each district. Okay. And then around 2,900 member commercial banks, almost all, most of the commercial banks in America are members of the Federal Reserve System. Okay, are part of the Federal Reserve System. So these are the 5. So what we're going to be doing in today, we're going to talk about the function of each of these entities of the Fed. Okay, so you can understand the complete structure or the institutional setup of the Federal Reserve System. But I want to direct your attention here. You see how complex the Federal Reserve is. Let me open this a little bit, maximize the screen here. So here's the structure of the Federal Reserve and monetary policy tools in the Federal Reserve System. So when we teach you principles on macro, which is a 2315 class, which is a class you guys took before this class, we talked about tools that the Federal Reserve will use, or the central bank is going to use, to control money supply and interest rates. We talked about open market operations, which is one of the major tools of monetary policy, like buying and selling of treasury bonds. We talked about the discount rate, which is the interest rate, and I hinted at that in chapter 9 when I was talking about management of financial institutions. We said the discount rate is the interest rate that the Federal Reserve is going to charge banks when banks borrow money from the Fed. Okay, so we're going to talk about who determines that discount rate, and then the open market operation is controlled by which branch of the Fed, entity of the Fed. We talked about in 2008, the Fed started a new tool of monetary policy, which is called paying interest rate on excess reserves. The Fed never paid interest rate on bank reserves ever since it was created, until the fall of 2008, when they started this new policy of paying interest rate on excess reserves. And then we shall talk about the reserve requirements, which I talked about too in chapter 9. Remember when I was talking about that when a customer deposits money in a bank, the Federal Reserve is going to set a fraction of that deposit must not be loaned out. The bank has to deposit that fraction to the Federal Reserve as required reserves. We talked about that. So this thing is very complex. When you see, so I said one of the entities of the Federal Reserve is a board of governors, 7 board of governors who sit in Washington, D.C. So what do the board of governors do? They're the ones who set limits on what? On the reserve requirement. And then the board also sets, they're the one who set interest rate paid on excess reserves, on bank excess reserve, because all banks in America have an account with the Fed called their reserve account. So if they have some excess reserves that they're depositing with their account with the Fed now pays interest rate on those reserves. And the body that sets what interest rate banks are supposed to earn on their excess reserve deposit with the Fed is the board of governors. They're the ones who were in charge with that role. And then the Federal Open Market Committee, which is this powerful 12-member body, which comprise of 7 members of the Board of Governors, plus presidents of Federal Reserve Bank of New York and 4 other Federal Reserve Bank presidents. Those 5. So 5 plus 7, it's a 12-member body. What do? They are the ones who set the what? Advises on what? So they're going to advise on discount rate policy. And then they're the ones who direct policy of buying or selling of treasury bonds to control money supply. We'll talk a lot about that. But the 12-member Federal Reserve banks, the 12 district branches that were talked about, all branches of the Fed across the country, they're the ones who establish the discount rate, okay, which is then ratified by the what? By the board. Okay, so here's the deal: the discount rate is not a set number for the whole country. Okay, so if let's say think about the Federal Reserve Bank of Dallas, because each of the district branches, Dallas is 11th district branch. So all private banks that are within this location, Texas area region, because they would be under the Dallas jurisdiction, the 11th district branch of the Federal Reserve. If a bank within the Texas jurisdiction, the Dallas Fed, wants to apply for discount loans from the Federal Reserve, they're going to go through the Dallas Fed. So if there's another bank which is in Boston that wanted to apply for a Federal Reserve loans or something like that, or discount loans from the Fed, they have to go through the Federal Reserve Bank of Boston, which is the 1st district branch. Or if you have a bank in San Francisco is the last district branch, it's the 12th district branch of the Federal Reserve System. And you own a bank in Los Angeles or in California or Salt Lake City, all those, the West Coast region, there's only one branch, and that's the San Francisco Fed. So you have to apply for discount loan through the San Francisco Fed. And each district branch can set their own discount rate or the interest rate that they're going to charge banks within their jurisdiction, on any discount loans that they extend to those banks. Okay? And then we talked about the Federal Advisory Council. There are 12 of them. Each of them represents the what? Representing the each district branch. So the Federal Advisory Council basically acts as a go-between between the district branch and the Board of Governors in DC. They go back and forth. They bring information from the board back to the district branch, take information from the district branch back to the board, those kind of stuff. So they act as a liaison between the Board of Governors in Washington, D.C. and the district branch. And then I talked about member banks. Now they're actually about 3,000 all-member commercial banks are part of are members of the Federal Reserve System. So that's how complex the institutional branches of the Fed. So now what we're going to do next, we're going to start discussing the role of each of these entities of the Fed. What are the functions of the Board of Governors, for example? What are the functions of the Federal Open Market Committee, these 12-member bodies that meet like 8 times a year in Washington, D.C., to decide whether or not to increase or decrease interest rates? What are the role of the 12 Federal Reserve banks, these district branches across the country, which I'll show you on the map. Okay? So now let's talk about the Federal Reserve banks first. So the Federal Reserve, when I say Federal Reserve banks, I mean these 12 district branches that I talked about that are all spread across the country. There are 12 of them. There are 12 Federal Reserve banks, all spread across the country. We have the Federal Reserve Bank of Boston. We have the Federal Reserve Bank of Philadelphia. We have the Federal Reserve Bank of New York. We have the Federal Reserve Bank of Chicago. We have the Federal Reserve Bank of Atlanta. We have the Federal Reserve Bank of St. Louis, Federal Reserve Bank of Kansas City, Federal Reserve Bank of Dallas. We have the Federal Reserve Bank of San Francisco. Okay, so I'm going to show you on the map the jurisdiction for each district branch. And then, of course, the headquarters of the Federal Reserve is in Washington, D.C., where the 7th Board of Governors sit, but with 12 branches all spread across the country. So let me show you the map in terms of the map here, then I'll talk about it. So this is a map of the United States. And I want to show you guys where the 12 district branches are located. So when the Federal Reserve was created in 1913, with headquarters in Washington, D.C., the first district branch of the Federal Reserve was the Boston Fed. So the Boston Fed is, see, Boston is here. So they'll see I draw the boundary. So this is around Boston area. This is going to be the first district branch of the Federal Reserve System. And by the way, when I say Boston Fed, it doesn't necessarily mean that it's only Boston, the city of Boston, Massachusetts, which is going to be part of that district branch. Sometimes it could spill over to some other states like Maine, New England, Maine, maybe Rhode Island, Massachusetts itself. So each district branch encompass a couple of states, even though is located in a city of one state, but it could have boundaries that extend across maybe 1 or 2, 3 states. I'm going to show you. And then we have the Federal Reserve Bank of New York is a second district branch of the Federal Reserve System. See the New York Fed? Okay. And then I want to let you guys know that there are also sub branches of the Federal Reserve. So we have the main district branch is in New York City. And then there's a sub branch in Buffalo, New York, a sub branch of that one, which is part of the New York Fed. They have an office in Buffalo, New York. And then the third district branch is the Federal Reserve Bank of Philadelphia, which is, you see, in terms of, so the maps are pretty much drawn. You can see that the boundaries are clearly marked here. And then we have, so Pittsburgh is a sub branch of the Philadelphia Fed, okay, district branch. And then the fourth district branch of the Federal Reserve is the Cleveland Fed, the Federal Reserve Bank of Cleveland. Okay, you can see Cleveland Fed has got sub offices. See, you can draw the district branch for the fourth district branch. It extends up to Kentucky, Louisville. So Louisville, Kentucky is part of the what? Of Cleveland. See? There's there are sub branches of the Cleveland Fed, the fourth district branch in Louisville, Kentucky, and Cincinnati, Ohio. But the main district branch is in Cleveland, the fourth district branch. And then the fifth district branch of the Federal Reserve Bank is the Federal Reserve Bank of Richmond, Virginia. See, right here. But Richmond, Virginia, see, extend all this, look at the boundary. It goes up to Charlotte, North Carolina. And there's a sub branch of the what? Of the Richmond Federal Reserve in Charlotte, North Carolina. And then, of course, the Board of Governors of the Federal Reserve System sit in Washington, D.C. Okay? Then the sixth district branch is the Federal Reserve Bank of Atlanta. Okay? So as you remember, talk about that even though each district branch is in a city or in a state, Atlanta is in Georgia, of course. The Atlanta branch, actually, Miami, Florida region, New Orleans, and Alabama, some part of Nashville, Tennessee, they are all part of the what? Of the sixth district branch, the Atlanta branch. So we have sub branches of Atlanta. Sixth district branch of the Federal Reserve in Jacksonville, Florida, Miami. There's a sub branch in New Orleans, and then there's a sub branch in Birmingham, and then Nashville, Tennessee. So the sixth district branch is fairly big. So it extends in a number of states, in Tennessee, in Florida, in Louisiana, because in New Orleans, you know what I mean, and then Birmingham, Alabama. So multiple states, are part of that jurisdiction. Okay, and then you can see the seventh district branch is the Federal Reserve Bank of Chicago. See that? It's up here. So here's the boundary of the Chicago Fed. So Detroit, Michigan is part of the Chicago. There's a sub branch of the Chicago Fed in Detroit, Michigan. And then the eighth district branch is the Federal Reserve Bank of St. Louis. And St. Louis is going to have their sub branches in Little Rock, Arkansas, and Memphis, Tennessee. Okay, so there are sub branches of the St. Louis Fed in Memphis and in Little Rock, Arkansas. And then the ninth district branch is the Federal Reserve Bank of Minneapolis. Okay, that's the ninth district branch of the Federal Reserve System. You go down to downtown Minneapolis, there's a branch of the Fed, that the ninth district branch. And then there's a sub office in Helena, city of Helena. Okay. And then the 10th district branch is the Federal Reserve Bank of Kansas City. That's a big branch too, because you can see the jurisdiction of the KC, Kansas City Fed. It extends up to Oklahoma. You see that? So I say, so each district branch can serve multiple states. Okay. See, the Kansas City Fed not only is in Kansas, in Kansas City, Missouri, but it extends to Denver, Colorado. Okay, there's a sub branch of the Kansas City Fed in Denver, Colorado, in Omaha, Nebraska, and then in Oklahoma City, in Oklahoma. See, so each branch may not, even though it's in Kansas City, Missouri, is going to extend to a number of states, cities in a broad states. Like, this is like multi-state, whatever, you see the several states there. And then the 11th district branch is in Dallas, just down here. We have the Federal Reserve Bank of Dallas is 11th district branch. And the sub branches of the Dallas Fed, they have an office in Houston, San Antonio, and El Paso. So the jurisdiction of the 11th district branch of Dallas Fed is pretty much clearly marked as the other districts as well. And then there's only one branch of the Fed. This is actually one of the largest branches of the Federal Reserve in terms of assets. It's the Federal Reserve Bank of San Francisco. There's only one branch of the Fed along the West Coast. Okay, and what makes this even large? Hawaii and Alaska, those are two states, are part of the San Francisco Fed. I think I mentioned it here. The boundaries of Federal Reserve District or Reserve Bank, the District 12, which is the San Francisco Fed, also include Alaska and Hawaii. And then, so then we have sub offices of the Federal Reserve branches. There's Seattle, Washington, Portland, Oregon, and then there's one in Los Angeles, then one in Salt Lake City, Utah. So all those are sub branches of the San Francisco Fed. So you see it extends in multiple states, in Washington State, in Oregon, in Utah, and then of course in California for the most part, So in terms of jurisdiction and the maps of the 12 district branches, so this is how brilliant the congressmen and women who wrote the Federal Reserve Act that created the Federal Reserve System. They made sure the Federal Reserve was created through a decentralized system, that there are branches of the Fed all over the country, so that if there's somebody who could hate the idea of centralization of power in Washington, D.C., they cannot blame this, because now, so if I wake up one morning and I live in Miami or I live in Jacksonville and I don't like power being centralized in DC, but I see a branch of the Fed in Jacksonville or in Miami or in, it puts some smile on my face that perhaps my viewpoints are being represented in monetary policy deliberations in Washington, D.C. Even though a lot of decision takes place in Washington, D.C., but branches are all over the country. So the Fed was created through that decentralized system. Okay. Okay. So now let's talk about we're going to talk about the structure of each district branch. Like when we talked about the Federal Reserve Bank of Dallas, which is the 11th district branch I showed you on the map, or the Federal Reserve Bank of Boston, the 1st district branch, or the San Francisco Fed, the 12th district branch, or the Federal Reserve Bank of Chicago, the Federal Reserve Bank of Kansas City. Okay, what is the institutional setup of each of those branches of the Fed? Okay, so the member banks elect 6 directors of each district. 3 more are appointed by the Board of Governors. So there are 9 directors in each of the branches of the Fed. Like the Dallas Fed has got 9 directors. Okay, I'm going to talk about what are those directors, where do they come from? And among the 9 directors, we appoint the president. So each district branch of the Dallas Fed has got a president of the what? Like there's a president of the Dallas Fed. Okay, so as I told you, the member bank elects 6. So 6 directors are going to be elected within the Dallas Fed, for example. And then 3 more are going to be appointed by the Board of Governors in Washington, D.C. The 7th Board of Governors will appoint three directors for each of the 12 district branches. So let's look at the classification of the nine directors that I talked about. So there's what we call 3A directors. 3 of the 9 directors are supposed to be professional bankers. So we call them 3A directors. Yeah, they're supposed to be people who have been their profession, has been in banking. They understand banks very well, how banks operate. Like we just talked about management of financial institutions. So some of them could be maybe former bank CEOs, people who have run banks, bank executives. Okay, so professional bankers. And then class 3 directors are prominent leaders from industry, like labor, agriculture, or consumer sector. So let me digest this a little bit. So if a district branch is located in a place where there's heavy agricultural activity, like for example in Kansas City, there's a lot of farming in Kansas. then they're going to make sure that, because since farming or agriculture is one of the major activities in Kansas, some of these directors should come from the farmers group. They're from the agricultural sector. Maybe group of some influential leaders in the farmers group in Kansas. Okay. Or if your district is located in a place where there are strong labor unions, like very close places like New York or like Wisconsin area, then maybe some of those directors should come from the labor unions. Okay. Or if your district is located in a place where there's a lot of manufacturing industry, and then those directors should come from industry. Or if they're coming from places where there's high-tech sector, like Silicon Valley, for example, San Francisco, for example, the 12 district branch, then some of those leaders or directors might be drawn from the tech sector. So it depends on where the jurisdiction is and what are the key or main economic activities are in those districts. That's where we're going to draw those 3B directors from. And then 3C directors are appointed. The 3A, 3B, those bring the numbers to 6. And then I told you that 3 other directors are appointed by the Board of Governors who sit in Washington, D.C. Okay, and they are not allowed to be officers, employees, or stockholders of banks because they want to avoid conflict of interest here. Okay, so and then the 9 directors appoint their own president, subject to approval by the Board of Governors in D.C. So you basically subject to ratification. So each board because the Dallas Fed has got those 9 directors, so they're going to sit down and appoint who's going to be their leader, who's going to be their president. Okay, so every district branch of the Federal Reserve, there are 12 of them, consists of 9 directors, and among those 9 directors, there's a president who's appointed from among the 9 directors. Okay, so let's talk about what are the functions of each of the district branch. What does the Dallas Fed do, for example, which is 11 district branch? Or what does the San Francisco Federal Reserve do in actual practice? So let's talk about the functions of these district branches of the Fed. So one of the things is, I remember I told you in chapter 9 when I was talking about management of financial institutions. Every check that is written in the United States goes through the check clearing process. So the Federal Reserve, these district branches of the Fed, they're going to clear checks. So if you live in Texas, and let's say you went to Walmart or H-E-B to do grocery shopping, so instead of using your debit card or cash or credit card, you decide to write a check to pay for your groceries. That check is going to be going through the Federal Reserve System of Dallas, the Federal Reserve of Dallas, which is the nearest, because we are under the Dallas jurisdiction for clearance. So all checks written in the United States go through the Federal Reserve System for clearance, but it depends. So if you live in San Francisco and you went shopping and you wrote a check, that check is going to go through the Federal Reserve Bank of San Francisco for clearance. If you live in Boston or in Boston area and you wrote a check, it's going to go through the Boston Fed. If you live in Atlanta, Georgia, you write a check, or places like Louisville, that check is going to go through the Federal Reserve Bank of Atlanta, and so on and so forth. And then the second function, so they clear checks. The second function is the Federal Reserve banks also issue new currencies. So if you have any damaged currency in your wallet, by damage I mean that you have some money like your dollar bill, which is getting wrinkled, which is getting dirty, and it's getting fading away really quick. Please don't throw it away. The role of the Federal Reserve, these district branches like the Dallas Fed, is to issue new currency, and they are going to withdraw damaged currency that you have in your wallet from circulation. So if you have a damaged currency in your wallet and you feel like it's dirty, you don't want to carry it, it looks nasty, you take it to you're not going to go to the Federal Reserve. You go to your bank, like Bank of America, because you and me, we got nothing to do with the Federal Reserve. Remember, you don't have an account with the Fed, but banks do. So if you have, so just go to your bank, like Bank of America, and say, here's the damaged currency. Can you issue me a new currency? They're going to give you a new dollar bill. And then Bank of America is going to take that damaged currency to the Federal Reserve. And the Fed is going to issue Bank of America new currency to replace it. That's the way it works. Okay? And then each district branch is also going to administer and make discount loans to banks in their district. That's right. I told you guys already that if you own a bank, a private bank, commercial bank in Texas, and you wanted to apply for a discount loan from the Federal Reserve, because the Federal Reserve is a banker's bank, and if they provide discount loans to banks and they charge discount rate, we saw that even in Chapter 9. If my bank wanted to apply for a credit from the Federal Reserve, and my bank is in Texas, because the jurisdiction is the Dallas Fed, then I have to go apply through the Dallas. I'm not going to be allowed to apply through the New York Fed. If you own a bank in New York City or around the New York area, and your private bank, you wanted to apply for a discount loan from a Fed, you're going to go through the Federal Reserve Bank of New York. Okay? You live in Boston, and so on and so forth. Okay? And then the other function of these district branches of the Fed, they evaluate proposed mergers and applications for banks to expand their activities. Okay? So if two banks might want to apply for mergers, they want to merge and become one. Like recently, there are two banks that merged to become one. Capital One just merged with Discover. This Discover Bank, they give a lot of consumer loan, like credit cards. So those two banks are merged to become one. So if two banks, like say, wanted to merge and become one, and let's say those banks were located in Texas, or one bank might even be out of Texas, but one is in Texas, and they want to go through maybe through the Dallas Fed. They're going to send application to the Dallas Fed, proposal for merging. Remember, the United States has got very stringent laws on monopoly. We call them antitrust laws. So even though banks may apply, they want to merge to become one bank, sometimes there are limits. The Fed might say no. For example, Bank of America is too big. You think if Bank of America ever applies for a merger that they want to merge with Citibank, the government is going to allow that? No, because they're going to be too big to monopolize the market. There are laws against monopoly, federal laws. We call them the antitrust laws. So they look at the market share, the potential market share, if two banks are applying to become one. If they are supposed to be controlling more than 50% of the market share, the Fed is going to say no. We're not going to allow that kind of merger. So that means, yeah. And then the banks also act as liaisons between the business community and the Federal Reserve System. That's true. That's true. So the Federal Reserve Bank of Dallas, they act as a go-between between the business community within the Dallas jurisdiction. And I'm going to show you, they use professional economists to research topics on. They collect a lot of data on local business conditions. Okay, so because each district branch employs like maybe hundreds and hundreds of economists, finance professionals, right? And sometimes economists at the PhD level, right? So they're all these economists and finance people, accountants that they employ, they're collecting all kinds of information within each jurisdiction. Business information, business startups, economic conditions, employment conditions, depending on the dominant side, they're going to collect all that information. Okay. And then they also one of the critical function of these district branches, they are tasked with examining bank holding companies and state chartered member banks. What are bank holding companies? Okay, bank holding companies is basically, you could think about a company which is not in banking. Let's say Walmart, which is one of the largest retail company in the United States. So like Walmart does retail business. This is not a bank. So if Walmart at one time decides that they also want to operate a bank, and let's say they apply for a license, they want to operate a bank, some bank called Walmart Bank. Then if Walmart gets approved to start a bank, we know the traditional function of Walmart is the retail business. You go buy stuff at Walmart, right? They are not a bank. But if they ever apply for a license to start a bank, then Walmart becomes a bank holding company. Okay? So one of the things that the government is going to do, if Walmart ever get approved to become start a bank on the side, the government is going to try to make sure that Walmart must separate its retail business activities from its banking activities. You cannot mix the two. Okay? Then, of course, there are banks that are chartered, owned by state, what we call state chartered member banks. So we're gonna, we're gonna examine those banks as well. Okay. And then I talked about collection of data on local business conditions using staffs of professional economists to research topics on related to the conduct of monetary policy. So let's talk about on the special role of the Federal Reserve Bank of New York. Okay. Remember the New York, when you go to there's a gold vault at the New York Federal Reserve. People think, we know the United States was under the gold standard. We abandoned the gold standard in 1971 when President Nixon just woke up one morning and said to hell with gold, right? But that doesn't mean that America got rid of its gold. America still has a ton of gold reserves. Okay, we were just running out of gold that reserve, but so Nixon just carried off in 1971. And I'll tell you a lot about the history of that in a separate discussion. The history of the gold standard, going back to periods that preceded the Bretton Woods. So when we abandon the gold standard, that doesn't necessarily mean that the United States ran out of gold completely. So we still have a ton of gold, so those gold is kept at the U.S. Federal Reserve. There's a gold vault there. You go, they open for you, and you can see gold bars for the U.S. government, kept at the U.S. Federal Reserve Bank of New York. It's one of the most beautiful Federal Reserve banks branches in the United States. People come from all over the world. It's like a major tourist attraction. And I have to advise most of you, you guys need to visit the Federal Reserve. Like you have the Dallas Fed here. Visiting a Dallas Fed is still very beautiful. It's very, visiting the Dallas Fed is easier than visiting the Federal Reserve Bank of New York. In New York Fed, you need to make an appointment probably 6 months in advance because it's a major tourist destination and it's overcrowding. They don't want many people. You want a few people once at a time. So, you need to make an appointment right on, like maybe 6 months in advance. Dallas Fed, you don't need, you can just come to me as a professor here at Texas State and I can write a letter. They typically don't like you to go there as an individual. They want you to go as a group of students, say from Texas State, maybe 5, 10 of you. You can organize and go for a tour. They're going to tour you. They're going to tour the Federal Reserve facility in New York. Is every branch. I've been to 7 of them, 7 out of the 12. They are all very beautiful. Like you go to the Dallas Fed, they basically built it with a hole inside the bank, and they show you that where they store money. You know what I mean? Because each district branch, by the way, there's a money printing center. Like for the Dallas Fed, there's a money printing center, which is located in Fort Worth, Texas, which is outside of Dallas. Okay? Because banks are Federal Reserve is supposed to, all banks in America have an account with the Federal Reserve. And sometimes Bank of America may ask the Fed that, oh, we want $1 billion of our money with the Fed shipped to Bank of America. So if you go to any Federal Reserve Bank facility, they show you where they store the money. They're ready because the banks have an account with the Fed. They may request $1 billion, $500 million, and they will show you the hammer trucks in the parking lot. So when Bank of America requests $1 billion, they're going to load those monies to cash in those hammer trucks, and they ship them to Bank of America. That's what it is. Okay? And they have amazing gift shops. You can go to the Federal Reserve Bank of Dallas, and you go to their gift shop, you can buy a piece of history to get. They sell you shredded money. You can buy some like maybe precious metals like coins, gold coins, or maybe silver coins that were used in the 17th century in the United States. Because America used a lot of silver and gold back then as a commodity money back in the days. So you can buy a piece of history. Very good. And they show you everything. Okay? So let's talk about the special role of the New York Federal Reserve, because the New York Fed is very beautiful. It has a lot of stuff. Okay. First, why the New York Federal Reserve District is special. This district contains many of the largest commercial banks in the United States, the safety and soundness of which are paramount to the health of the U.S. financial system. Because New York, that's where we have Wall Street. Major banks on Wall Street are located in New York, Wall Street banks. So remember, one of the main reasons why we created a central bank is for regulating. The Federal Reserve is supposed to regulate all banks private banks in the United States. So that means the New York Fed has got a lot of work when it comes to bank regulation because that's where most banks are concentrated. Okay, in New York City. Okay. The second reason why the New York is a special active involvement in the bond and foreign exchange markets. We're going to talk about one of the functions, one of the key tools that the Federal Reserve uses to control the supply of dollars in the economy is buying and selling of treasury bonds. The Federal Reserve, just like any other central bank, of other countries, is the custodian of what? Of U.S. government debt. What do I mean by this? The Federal Reserve holds a lot of U.S. treasury bonds on its balance sheet as an asset. The Fed runs like a private bank. That's why the Federal Reserve is supposed to be very independent from government. So they hold a ton of U.S. Treasury securities on their balance sheet as their asset, and the Fed makes millions, billions in what? In interest payments on those bonds. So the New York Fed is the one supposed to be acting on behalf of the Federal Reserve, buying and selling of treasury bonds to influence money supply in the economy. So in 2315, which is the principles of macro, your baby economics class, the first economics class you took, we show you that what? When the Fed wants to increase the money supply, they're going to conduct an open market purchase of treasury bonds, either from banks or from the non-bank public. So when the Fed is buying bond, a bond is basically a piece of paper, it's an IOU document. When the Fed buys these pieces of paper, assets called bonds, the Fed is taking away these pieces of paper, but we're leaving the public or banks with what? With money. That's how money supply goes up. When the Fed wants to decrease the money supply, they're going to do the exact opposite. They're going to sell treasury bonds to either banks or to the non-bank public. So selling these pieces of paper called bonds, IOU document. So then if the Fed is selling this to the public would be paying for those bonds using money. So the Fed would be withdrawing money in circulation from the economy. That's how that leads to a decrease in the money supply in the economy. Okay. So the New York Fed is the one that does this. When the Fed wants to say sell $1 billion of treasury securities, or they want to buy $1 trillion worth of treasury securities from banks or from the non-bank public, there's a trading desk which is at the New York Fed. They go through the New York Fed to execute that purchase. Okay. The New York Fed also acts as they also have a foreign exchange market, because sometimes or occasionally the central bank can intervene in the currency market, in the foreign exchange market, to smooth out the volatility in the dollar. If the dollar is losing value, okay, we're not like the Chinese, the People's Bank of China. They fix the currency and they don't want the yuan to change at all. We are not like that. The US move away from that. So if the dollar depreciate 5-10% here, 3, 4, 5%, we let that go. But let me tell you one thing. If one day we wake up and the dollar has depreciated or lost 40% of its value, the Fed is going to act. You know what I mean? So all banks in the United States, all central banks, including the Federal Reserve, will keep a ton of international currency reserves at their disposal. So the Federal Reserve has a bunch of Japanese yen. They keep a bunch of Chinese yuan, the euros. They keep a bunch of like the Mexican peso, the Canadian dollar, the major currencies around the world. So that, let's say if the dollar is decreasing too much in value and the Fed doesn't like it, let's say a 40% wiped out in the value of the dollar, the Fed is going to use its international currency reserves like the yen, the pound sterling, the euros, the Mexican peso, the Canadian dollar. They're going to use those currency deposit or reserves to buy off the US dollars from the market. That means the Fed will be dumping foreign currency in the marketplace. That will allow the dollar to gain value to where the Fed wants it to be. And the opposite is true. If the dollar gains too much value, the dollar appreciates too much, let's say by 40, 50%, that's not good either. That's bad for trade. And that means our goods become expensive. So the Federal Reserve is going to act by buying international currencies off the market, like buying the yen, buying the whatever. So they're going to accumulate more international currency reserve. That means they would be dumping more dollars in the market to let the dollar depreciate because they fear the dollar is gaining but appreciating too much. So we'll talk about it. So all those happened through the Federal Reserve Bank of New York. The Federal Reserve Bank of New York has that trading desk, trading bonds, treasury bonds, and also trading foreign currency on behalf of the Federal Reserve System. When they trade foreign currency, they're not doing it to make money. They're using that as a mechanism for smoothing out the volatility in the value of the US dollar. We don't want the dollar to be so volatile. And then the third reason for the Federal Reserve Bank of New York's prominence is that it's the only Federal Reserve which is a member of the Bank of International Settlements. So the Bank of International Settlement has got headquarters in Basel, Switzerland. Okay, so it basically is a large international an entity that represents almost all groups of large commercial banks and other central banks around the world. So we led the New York Fed to represent the U.S. Federal Reserve at the Bank of International Settlement in Basel, Switzerland. And then finally, why the New York Fed has a prominent role. I told you one of the most important committee or agency of the Federal Reserve is the Federal Open Market Committee. It's a 12-member body. So this is a committee which is so powerful. They meet about 8 times in a year to decide on whether or not to increase interest rates, the federal funds rate, or whether or not to increase money supply or decrease money supply. Okay? So when the Fed wants to increase or decrease interest rate, they're going to be buying and selling of treasury bonds. Okay? So this decision is made by this committee. They have the 12-member body. This committee has got 7 board of governors. The 7 board of governors who sit in Washington, D.C. And then the president of the New York Federal Reserve, the second district branch of the Federal Reserve System, the New York Fed, has got permanent representation on this committee. It has got a permanent voting right on this committee. So that brings the number to 8 because we have 7 board of governors and the New York Fed has got so then the other 4 members, we draw them from presidents from the other district branches across the country. You know, there are 12 district branches. So if the New York Fed president is having a permanent voting representation on this committee, plus the 7 board of governors who sit in Washington, that the number is 8. What about the other 4 members? The other 4 members are going to be other presidents of the other Federal Reserve district branches who serve on a rotating basis of 1 year. So if this year, for example, the president of the Boston Fed, the Atlanta Fed president, or the president of the Kansas City Fed, president of St. Louis Fed are serving, next year they're not going to serve. We're going to rotate membership, appoint 4 others, but the New York Fed president is going to be permanently serving on this committee. So so these are the few reasons why the New York Fed has got a special role to play as a unique district or branch of the Federal Reserve System compared to the other 11 district branches. This is the unique role of the New York Fed. Okay, so let's continue more. Talk about the Federal Reserve banks and monetary policy. So we talk about what do they do. So each district branch is gonna talked about even a little bit earlier. Each district branch is going to establish the discount rate. The discount rate, like I showed you guys in chapter 9, is the interest rate that banks will be charged by the Federal Reserve if they borrow money from the Fed. So each district branch, or the directors of each district, there are 9 directors of each branch, they are the ones going to establish or set the discount rate. So the Dallas Fed is going to say, well, if any private bank within our jurisdiction, within the Dallas Fed jurisdiction, want to borrow money from the Dallas Fed, we're going to charge them maybe a 5% discount rate. Okay, and then they also decide which banks can obtain discount loans. I even told you guys in chapter 9 that it's not, even though banks may borrow from the Fed, but the borrowing is not automatic. Okay, if some bank goes to borrow money from the Fed, they may get denied credit, just like we ordinary Americans. If you try to borrow money from your bank might say no. That's the same thing when banks are borrowing from a Fed, they need to be evaluated. So the district branches are going to decide whether or not to approve such loans. And then the directors are going to select one commercial banker from each district to serve on the Federal Advisory Council, which consults with the Board of Governors and provides information to help conduct monetary policy. So like the Dallas Fed is going to appoint one professional commercial banker who is going to act as a liaison between that district branch and the Board of Governors in DC. So this person will be like a go-between. They would travel to Washington, D.C., meet with the Board of Governors. If there's any information to be brought back to the district branch, that is their role. Those are the roles of the Federal Advisory Council. So there are 12 of them because there are 12 district branches of the Federal Reserve. Each district branch will appoint a professional commercial banker who will be to become their Federal Advisory Council. Okay? And then 5 of the 12 bank presidents have a vote in the Federal Open Market Committee. I already talked about this. The FOMC, which is this powerful 12-member body that makes monetary policy, that decides on whether to increase interest rates or decrease interest rates. There are 7 board of governors there. Then there are 5 presidents of the other district branch. But the New York Fed is a permanent member of that committee. Then the other 4 presidents I talked about serve on a rotating basis of 1 year. So we talked about that. What about the member banks? So those are basically the role of played by the what? By the Federal Reserve Bank, these 12 district branches. They're very powerful. They do a lot when you think about it. Okay, so let's talk about the member banks. So all private banks in the commercial banks, national banks, are required to be members of the Federal Reserve System. But commercial banks which are chartered by states, which you can call state-owned banks, are not required, but may choose to be members. So it's not mandatory that if a state chartered bank to become a member of the Federal Reserve System, they may or may not want to be part of the Federal Reserve System. But there was a law that was passed in Congress in 1980. It's called the Depository Institution Deregulation and Monetary Control Act of 1980. It subjected all banks to the same reserve requirements as member banks and gave all banks access to Federal Reserve facilities. So even though you're a state chartered bank and you are not a member of the Federal Reserve System, this law says that even though you're not a member of the Federal Reserve System, you are still have to adhere with some of the regulatory requirements, like the what? Like the minimum reserve requirements that the other banks that are members of the Fed are part of. So this is a uniqueness of the central bank, of the Federal Reserve, the U.S. Federal Reserve System, that, all commercial banks are all members of the Federal Reserve System. So the Federal Reserve banks, these 12 district branches, are basically quasi-public and quasi-private institutions that are owned by private banks in the districts where they are located. So you can talk about like that. So it's part private and part public. You're not going to find any central bank with this unique feature. You go to the bank, the Bank of Japan. The Central Bank of Japan is 100% owned by the Japanese government. The Bank of England, 100% owned. The German Bundesbank, okay, those kind of stuff, okay? The People's Bank of China, the Riksbank of Sweden, the Reserve Bank of Australia, the Bank of Canada, Banco de Mexico, which is the central bank of. So all these central banks for all these countries, they are almost like 100% government owned. But the Federal Reserve is very unique. That is part private and part public, because the 12 district branches of the Federal Reserve are partly owned by the public and partly owned by private commercial banks in the districts where they are located. So that's a uniqueness of the U.S. central banking system. Okay. So that's about member banks. So let's talk about the Board of Governors. So there are 7 Board of Governors who sit in Washington, D.C. So the 7 Board of Governors are appointed by the President of the United States, and each of them is confirmed by the Senate. And each of them serves a 14-year non-renewable term. That was designed for a reason. We want, and by the way, not all 7 Board of Governors time of appointment is the same. No. Maybe one Board of Governors might have been appointed by let's say President George W. Bush. They're still serving on their 14-year non-renewable term. Maybe, or maybe they were appointed by President Obama. Okay, or some of them were appointed by Biden. Some of them were appointed by Trump. We're not going to allow all 7 Board of Governors to be appointed by a single president, because we want to shield the Federal Reserve from political interference. That is what the President of the United States only serves a two term, like 8-year term, right? But the members of the Board of Governors of the Federal Reserve serve 14 longer terms than the President of the United States. because we don't want the terms, the presidential terms, to be concurrent with the terms of the members of the Board of Governors of the Federal Reserve System. Okay? We want to shield them from political interference as much as we can. And we cannot, and then all seven we cannot say that all seven Board of Governors are going to come from Texas, or they're all going to come from California. You know, they're supposed to be spread all over the country, come from different regions for representation, come from different districts. And then among the seven Board of Governors, the President of the United States is going to appoint the chair. The chairman is chosen from the Board of Governors and serves a 14-year term, a 4-year term. So the chair of the Federal Reserve, like Jeremy Powell, okay, serves a 4-year renewable term, okay? And by the way, you guys need to know who the chairs of the Federal Reserves have been ever since the Federal Reserve was created in 1913. Just like you guys are always very interested in knowing about who was the president of the United States going back to the nation's founding. I would be interested as an economic student to know who served as the chair of the Federal Reserve in the 1980s, in the 1990s, although you may not go far back to 1930, but it's good to Google and know about it. This is something that you can do during your free time. Like the current chair of the Federal Reserve is Jeremy Powell. Who was his who served before Jeremy Powell? It was Janet Yellen. Okay, Janet Yellen was appointed by President Obama, the first ever female to ever serve as the chair of the Federal Reserve. But before Janet Yellen served as chair of the Federal Reserve, we had Ben Bernanke. Ben Bernanke served for 8 years. He was appointed by George W. Bush, President Bush, and his term was renewed by President Obama. Okay, and a president can refuse to renew. The chair of the Fed may or may not serve 8 years. Okay, like Janet Yellen only served for 4 years, because I remember when during the first Trump administration, Obama was the one who appointed Yellen. But when Obama was like in his third or second year in the towards the end of his presidency, second year of his second term, you know what I mean? So after that, when Trump was running for president, he made it clear that was going to renew Janet Yellen whatever term as chair of the Federal Reserve, and he did exactly that. He appointed Powell. But Bernanke served for 8 years. Before Bernanke, we had Alan Greenspan. Alan Greenspan is the longest serving chair of the Federal Reserve System. He served for 19 years. Okay, let me make that clear. Alan Greenspan is the longest serving chair of the Federal Reserve System. He served from 1987 to 2006. And then you can go back in time, like we have other Fed chairs like Paul Volcker, who served who came in 1979. You go back to Asher Barnes, going back in history. So you can read about the style of their administration, or what those, the politics, or the mode of operation that each chair, of the Federal Reserve embrace. Okay, so here's the deal. The chair of the Federal Reserve is they double as chair of the governors. So if you're chosen as a chair, you're chair of the Board of Governors. You're the one who chairs these 7 Board of Governors. And then you're also the chair of the Federal Open Market Committee. Remember, these 12-member bodies that meet about 8 times in a year to decide matters on interest rates. It is the chair of the Federal Reserve that chairs that meeting as well. So the chair of the Board of Governors also doubles as a chair of the Federal Open Market Committee. And they're the ones who set the agenda for the meeting, this kind of stuff. So what are the duties of the Board of Governors, the 7 Board of Governors? They're going to vote on conduct of open market operations, okay, because they are members of the Federal Open Market Committee, so they have to vote. And then they're the ones who set the reserve requirements. This fraction that the Federal Reserve set, saying that every deposit made in a bank, a fraction of which must not be lent out. It is set by the Board of Governors, okay? And then they also control the discount rate through review and determination process. So even though I told you that the discount rate, which is the interest rate that the Federal Reserve Bank charges when banks borrow from the Fed, that is set at the district branch, like at the Dallas Fed. When the Dallas Fed sets its discount rate, it still has to send it to the Board of Governors in Washington, D.C. for reviews and ratification, okay? And then they set the margin requirements. I'm going to talk about margin requirements. Right now, you're not going to get it right later in the chapters. And then they also set the salaries of president and officers of each Federal Reserve Bank and reviews each bank's budget. So the board of governors are going to set that. They want to set the salaries of the board of directors at the district branch and the salary of the president of each district branch. There are 12 district branches, remember. Their salaries are determined by the board of governors. And then also they also must approve the budget, operational budget for each district branch. And then they approve bank mergers and application for new activities. So if two banks apply for merger, that application is going to go through the district branch. But the final approval, whether two banks have to merge to become one bank, rests with the board of governors. That's where the final approval. And then they're going to specify the permissible activities of bank holding companies. I already told you guys what bank holding companies are. If a company that did not have a bank before, like Walmart, that is, or Target, that their job is, their activities in retail, if they decide to apply for a license to begin a bank on the side, they become a bank holding company. So the board of governors are going to determine what are the permissible activities of bank holding companies. What can they do and what can they not do? Okay. First of all, I told you already, if you become a bank holding company, let's say Walmart ever applies for a license and start a bank on alongside its regular retail business activity, then Walmart is asked to separate its retail business activities from its banking activities. We cannot mix the two. So those are the things that are going to be determined by the board. And then they supervise the activities of foreign banks operating in the United States. That's always tricky. We have so many banks, so many Swiss banks that operate in the United States, like UBS is a Swiss bank. Several foreign banks operating in America. Okay, there's a tendency if a bank, let's say out of Switzerland, has a branch in the United States, they have to follow US laws. They cannot follow the laws of Switzerland because now they're operating inside the United States. Just like if an American bank, like Bank of America, has got a branch in England or in France or in Switzerland, they have to follow the laws of those countries as well. Okay, so the board of governors are going to supervise activities of those foreign banks, making sure that they're following up with all the US banking laws. Okay, so that's what they do. Let's talk about the chair of the board of governors, because that's one of the most important person at the Federal Reserve, like Jeremy Powell. Okay, so the chair of the board of governors is going to advise the president of the United States on economic policy, and then they testify in Congress, maybe once, sometimes twice a year, on the Federal Reserve monetary policy, because Congress are going to sometimes hold them, because there has to be checks and balances, hold them accountable, make sure that they go and tell Congress what the Fed has been up to, whether they've been controlling inflation or whether unemployment is getting out of whack, because those are the things that Congress cares about. The two dual mandates of the Fed is basically maintaining price stability, making sure that inflation doesn't get out of control, and making sure that the economy is producing at near full employment, okay, maximum employment, okay? And then the chair of the Fed also speaks for the Federal Reserve to the media, okay? There's a person who does a press conference on behalf of the Fed. And by the way, when the Federal Reserve meets, the FOMC meets, and then they decide on interest rate, it's the chair of the Federal Reserve that they will release a statement, and then the chair of the Fed is going to take questions from the media. Why the Fed, for example, has increased the interest rate, the federal funds rate, or why they decrease the interest rate. He's the one who is supposed to speak to the media on behalf of the Federal Reserve. And then the chair may also represent the United States in negotiation with foreign governments on economic matters. This could be on debt issues, debt negotiation and stuff like that, sometimes or even on trade, okay? What about the role of the research staff? So the Federal Reserve System is the largest employer of economists, not just in the United States, but in the world. I just have to let you know that. And, there are great benefits there. The most important task of the Fed's economists is to follow the incoming economic data from government agencies and private sector organizations and provide guidance to the policymakers on the direction in which the economy might be headed and the potential impact of monetary policy actions on the economy. So these economists are collecting a lot of economic data from business ventures, from consumer sector, from labor union, all kinds of economic data. And then they publish them. We use that to publish papers. So those papers that they write based on this economic data are supposed to inform monetary policy, inform the Federal Open Market Committee on the next course of action on interest rates. Okay. Now let's turn to the Federal Open Market Committee, which is this 14-year member body, what is perhaps one of the most important or most powerful agency of the Fed. So they meet 8 times in a year to decide on interest rate. So it consists of 7 members of the Board of Governors that I talked about, the President of the Federal Reserve Bank of New York, and the President of 4 other Reserve Banks. Of the other 11 remaining Reserve Banks, they serve on a rotating basis of 1 year. I talked about that already. So the chair of the Board of Governors, I talked about that, is also double. Jeremy Powell also doubles as a chair of the what? Of this committee, of the Federal Open Market Committee. So they issue directives to the trading desk at the Federal. So what happens if the Federal Reserve wants to say to lower interest rate? Lowering interest rate means the Fed. We're going to be talking about these technicalities in the next. Right now, I'm just presenting, because for me to start talking about monetary policy, I want you guys to understand. That's why I'm going a little fast, because this is something I should have given you guys this as a reading assignment. But I want you guys to understand what each of these entities of the Federal Reserve, what are their functions. And then we're going to start breaking down. We're going to start talking about monetary policy. There are going to be a couple of equations and math we're going to do in the chapters ahead. But this is just to preview to you, give you the institutional setup of the Federal Reserve. It's very important. It's key. Because if you don't understand what branch of the Fed or agency of the Federal Reserve System does what, then you're not going to be able to understand monetary policy. So you need to understand this institutional arrangement, institutional setup of the what? Of the Federal Reserve System before we even talk about monetary policy, which we are going to be doing actually next in the next chapters. All right, so they're gonna issue, if they want to buy, like, say, $1 billion or $1 trillion worth of treasury bonds from banks, they're going to issue the directive. The Federal Open Market Committee issued directive to the trading desk at the New York Fed. There is a trading desk at the New York Fed. So they're going to authorize the New York Fed to go ahead with that bond purchase. Going to buy $1 trillion worth of treasury bonds from banks, because the goal is to lower interest rate and increase money supply. If the Fed buys bonds, that means money supply. They're leaving banks with money, and that money supply goes up. That'll tend to lower interest rates. That, maybe the Fed might, the committee is going to meet, they look at the dangers to the economy. If they see the economy is about to go to a terrible recession, that means the Fed needs to lower interest rates to keep the economy strong. Okay? So lowering interest rate involves bond purchase, treasury bond purchase, okay, which would eventually increase money supply, and that interest rate is going to fall. We'll talk more about that. But that happens they're going to issue the directive through them to the trading desk at the Federal Reserve Bank of New York. That's what the FOMC does. So I'm not going to go ahead and talk a lot about inside the meeting, because there are politics. You can read this on your own. It gets a little boring. The report by the manager of a system open operation on foreign currencies and you can read the presentation with board staff, national economic forecast. You can read that on your own, So, but what I want to talk about, there are some important books, colors of the books at the Federal Reserve. When the Federal Open Market Committee is meeting, there are some books with some colored, different colors. We have the books which have got green colors. The back of the book is green color. There's a blue book, then there's a teal book, and there's a beige book. So what do these colors mean at the Fed? So up until 2010, a detailed national forecast for the next 3 years was placed between green covers, and it was just known as the green book. It was placed in a book with a green cover. So if you want to go, let's say you're a member of the FOMC, we're going for a meeting, and you want to know the forecast on, like, say, GDP, how the Fed thinks the economy is going to grow in the next 3 years. Or you want to know what the Fed is forecasting, they're predicting what, maybe interest rate or inflation to be in the next 3 years. You're going to look for that information in the books with a green cover, because that's where national forecasts for major economic, macroeconomic variables are found. They will place them in those books with green covers. But projections for monetary aggregates, along with typically 3 alternative scenarios for stance of monetary policy, labeled A, B, and C, were contained in the blue book. So the Fed has got different scenarios on what they want, how to change the money supply going forward. They will play with this simulation. They're going to say, okay, suppose the economy grows by 6%. Growth is exploding. Maybe there are fears of inflation. The Fed may be forced to cut what? To cut money supply and raise interest rate. So or what about if the economy falls, in a recession where growth is slowing down? How should the Fed act? So details of that is going to be found in this book, which has got a what? Blue cover, the blue book. But starting in 2010, the green book, the books that provided forecasts for major macroeconomic variables, and the books that provide stance on monetary aggregates like money supply, M1, M2 that we talked about, they were merged into one book, and they call it the what? The beige book. Sorry, the teal book. They merged those two books from 2010 and up to now. Now we no longer have the what? From 2010 up to today, we no longer have the green book or the blue book. But they used to separate them before 2010. Those books have been merged into a book which is called the what? The teal book. It has a teal cover. And then the beige book is produced by the reserve banks and details evidence gleaned either from surveys or from talks with key businesses. So like say the Dallas Fed, the economists at the Dallas Fed are basically doing a lot of surveys on economic issues, collecting a lot of economic data, and then they're publishing those, regional economic, data, or how the economy is performing at the regional levels in their districts. All that information is going to be placed in a book with a what? Which is called the beige book. So that's what those books with different, covers, the colors of those books represent, what is in that book. So if you're a member of the Federal Open Market Committee, you want to look for information about how the regional economies are doing, like how the economies within Texas region is doing. You're going to find that the Dallas economies would have placed their forecasts or surveys of business activities within the Dallas region in that beige book. If you want to see how, you want to look for what business conditions are in, places like Kansas in the middle of the country, or St. Louis area, or in the western region like San Francisco, they would have placed their forecast on business condition in those regions in that beige book. So then when because you need to be informed both at the national level, aggregate for economic issues and also regional economic issues before you make decision to vote on interest rates as a member of the committee. Okay. So let's talk about why the chair of the Federal Reserve runs the show. Where is the most important person who leads the Fed? The chair is a spokesperson for the Federal Reserve and negotiates with Congress and the President of the United States. When the Federal Open Market Committee, when this committee is meeting, is the chair of the Federal Reserve who sets the agenda for the meeting. And the chair speaks and votes first about monetary policy. The chair also supervises professional economists and advisors who are working at the Board of Governors of the Federal Reserve System. In Washington, D.C., there are hundreds and hundreds of economists who work at the Board of Governors of the Federal Reserve System. It's a big place. And then again, I told you that Alan Greenspan was the longest serving chair of the Fed. He served for 19 years, from 1987 to 2006. He's the longest serving chair of the Federal Reserve. Most of the other chairs, they would serve 4 years, 8 years. Ben Bernanke served 8-year term. Janet Yellen served only 4 years. Now we have Jeremy Powell. These are the contemporary chairs of the Fed. Okay? So if you want to see their style, because the style of every chair is different, the way they hold the meetings, the politics behind the meetings is a little different. You can go and read on your own. I'm not going to go into the politics or how each chair is different from the other. If you want to know more of that information, those are the things that I'm not going to bring you on the test. I'm not going to ask you those ridiculous questions about, how different was Ben Bernanke, in terms of his style, But if you want to know that, you can go and read more on that. Okay, so that concludes our discussion about the different agencies of the Fed. So we talked about the Federal Reserve banks, which are these 12 district branches all spread across the country. What are their functions? So make sure you understand them. We talked about the board of governors, the 7 board of governors who sit in Washington, D.C. What do they do? What are their mandates? What are their functions? We talked about the chair of the Federal Reserve System, like Jeremy Powell. What are the main roles of the chair of the Federal Reserve? We talked about the Federal Advisory Council, which is this liaison, which acts as a go-between each district branch and the board of governors in D.C. We talked about the 3,000 member commercial banks, which are part of the Federal Reserve banks, okay? And then we talked about the Federal Open Market Committee, which is these 12-member bodies charged with making monetary policy. So your goal is to understand clearly what each of those entities of the Fed, what they do in actual practice. So that's what we just talked about, okay? Now, what we're going to be discussing next, we're going to start talking about the issues of independence of a central bank, like the Federal Reserve. Because let me tell you, we do not want our central bank to be interfered with by politicians, okay? And let me give you just into context why the Federal Reserve is the way we treat the level of independence of the Federal Reserve here in America is the way we should treat independence of the other 3 branches of the government, the legislature, the judiciary, and the executive branch. Those 3 branches of government have checks on each other, but they're supposed to be independent. No, nobody should be stepping on that, but they provide checks and balances. The Federal Reserve also is like that. We should treat the Fed as independent as the way we treat the other 3 branches of government. Okay, here's one deal. The president, let me tell you, the president of the United States even has no power to fire the what? To get rid of the chair of the Federal Reserve, to fire the chair of the Fed, as long as that chair is serving their term. Okay? Remember, so let's say Jeremy Powell is serving his term, which ends in about a year and a half. President Trump cannot fire him. He has no mandate. Okay? So let's talk about how independent is a Fed. So independence of the Fed comes in the form of what we call instrument independence and goal independence. It also comes in terms of revenue independence. I'm going to start with that. This is another unique feature of the U.S. Federal Reserve System, which might be a little different from other central banks around the world. The U.S. Federal Reserve is part of government, but it's the only government entity, the Federal Reserve, the central bank of the United States, go look it up, is the only part of government that does not draw a budget from the U.S. government. If you go and look at the budget of the U.S. government, where the government has budgeted for several, like say the Department of Health, Department of Agriculture, Department of Education, the Foreign Affairs, Secretary, State, those kind of stuff. The Federal Reserve, you're not going to find the Fed there. The Federal Reserve runs its activities like a private entity. In other words, the Federal Reserve makes its own independent revenue, which they use for running the Fed. Because I told you that the Federal Reserve is a custodian of U.S. government bonds. They invest a lot in U.S. Treasury securities. They hold that on their balance sheet. And the Fed makes billions and billions in interest income from their investment on these bonds. The Federal Reserve also loaned money to banks, and they charge bank interest rate. So the Fed runs as a private entity. And by the way, this is what actually makes me very excited, because, for politicians sometimes to meddle on the affairs of an aspect of government, politicians always threaten that they're going to cut funding to a government department if the government department does not do as they wish. You know that. That's what they do. They always threaten to cut funding to, say, a government entity. They cannot do that to the Fed. Why? Because the Fed does not draw a budget from the U.S. government. The Fed has got its own independent revenue sources. In fact, the Fed subsidizes U.S. taxpayers. Why? The Federal Reserve makes billions of dollars every year in interest income and maybe interest on discount in the discount rate that they charge banks when they loan money to banks and other activities. And part of that money that the Fed makes, the profit they make every year, they use it for running the Fed. But whatever remains, the Federal Reserve always donate it back to the U.S. Treasury. They donate part of the money they make back to the U.S. Treasury. So by that, the Fed is actually subsidizing U.S. taxpayers. Okay? Okay, so the Fed has got the independent revenue source. And then the second thing is the Fed also sets its own goals. There are several goals of monetary policy that any central bank can set. For example, for the Fed, there are two main, there are six, about six goals, but the main ones are price stability. The Fed wants to maintain, they want to set the goal on inflation. How much inflation should we have in the economy that can maintain that price? Oh, how much price stability should we have in the economy? The Fed is going to set the goal of maximum employment. Okay, they want to make sure that Americans are not faced with high unemployment problems, maximum employment. The Fed sets the goal of stability of financial institutions, stability of financial system, which include both institutions and markets. The Fed has a goal of stability in interest rate. Okay, and then the other goal like stability in the foreign exchange market, making sure that the dollar is not very volatile. So those are the broad goals of monetary policy that we're going to be talking about in the upcoming chapters, towards the last of the chapters. But the two main goals of monetary policy that the Fed, that was actually, we call this the dual mandate, these two. So when Congress, okay, be careful what you wish for. Even though we're saying that the Fed is independent, to some extent, of course, there's going to be some little bit of political interference, but not fully. Okay. For example, we're saying that it's the president of the United States who is going to be appointing the 7 board of governors, and the president appoint the chair. So the president can be maybe biased on who they want to serve as a chair if that falls during the administration. Okay. So there's some little bit of flaw, whatever. So, but and also another thing that you should be worried about is that Congress was the one that wrote the Federal Reserve Act, an act of Congress that was passed into law in 1913, which created the Federal Reserve in the first place. Remember that. It was written by politicians in Congress. So what does that mean? If there was an act of Congress that created this elaborate system of checks and balances that govern the Federal Reserve System with all these different entities that we just talked about, that means Congress can change whatever maybe they may come back tomorrow and who knows, they may change some of those laws governing how the Fed should be run, because it was written by Congress. But the good news is that ever since the Fed was created in 1913, the Congress never did that. Okay, they let the Fed run independently. But the Federal Reserve has to testify on Capitol Hill in Congress through the chair of the Federal Reserve at least once or twice a year. So when Congress wrote the Federal Reserve Act, they're going to say, well, we will let the Fed do whatever they want, setting its independent goal. But we care too as Congress. We want at least these two goals. For the Fed to be accountable, they should come to Congress and tell us how are they controlling inflation or price stability? How are they putting Americans to work in terms of stability in the labor market, employment. So we call those the dual mandates that Congress want the Fed at least to achieve, achieve at least a goal of price stability and maximum employment. And if they don't, they're always going to pressure, bring the chair of the Fed to Congress for congressional grilling. They're going to ask them tough questions. Why are they not doing that? Okay, and then there's what we call instrument independence. So the goals are these broad goals of monetary policy. The instruments are going to be the tactics that the Fed, what would the Fed use to achieve those broad goals? We want those small tactics that the Fed is going to use to achieve those goals, which I'm going to talk about later too. Also to be as independent from what? From politicians. Politicians should not tell the Fed what they need to do to achieve these goals. Okay, so the Fed has got both instrument and goal independence. They are independent revenue source. Okay, so I told you that the Fed structure was written by Congress and is subject to change at any time. Congress was the one who wrote the Federal Reserve Act in 1913 that created the Federal Reserve in the first place. So they could change it, but the good news, they have never done it. So there's some little bit of presidential influence on Congress, appointment of members of the Federal Reserve. The president appoints a chair. I talked about that. So a little bit of, but not fully. The Fed is still very independent. So there's debate out there. Should we allow our central bank, the Federal Reserve Bank, to be completely independent without maybe any checks? Okay, so there are pros and cons. There are advantages of making a central bank like the Federal Reserve independent, and then there are cons, there are disadvantages, okay? So here's the case for independence. So the strongest argument for an independent central bank rests on the view that subjugating or subjecting the Federal Reserve to more political pressures from may impart some inflationary bias to monetary policy. Let me expand this a little bit and talk a little bit about it. Let me talk a little bit about this. Why we don't want the Fed to be influenced politically, because subjugating the Fed to political pressure is going to introduce this inflationary bias to monetary policy. What do we mean by that? So if you go to some countries whose central banks are not independent, like countries that are run by dictators, okay, they can choose to do whatever they want, okay? Because countries are, if you think about, if you're the central bank, head of North Korea, okay, if Kim Jong-un comes and tell you what to do and you say no, what do you think is going to happen to you? You already know what's going to happen to you. So you have countries that are run by dictators who might dictate policy on how they want. Their politicians are going to dictate. The question is, how bad is that? Okay, so we can tie this to what we call, we can tie inflation to political business cycle. And this is something we want to avoid. This happens in third world countries, in developing nations. There's some emerging markets, mostly countries that are run by dictators, right? So what do I mean by political business cycles here? So in developing countries, a country, maybe an incumbent president might be going up for re-election. Let me show you what happens. So I'm gonna put political business cycle here. And I'm gonna put on this axis inflationary bias. So when I say political business cycle, I mean like major election cycle. Okay, so let's say the term of a president in a developing country is every 5 years. So they already know that every 5 years they're running for re-election, and some of those presidents want to be there for life presidents, dictators who want to be in power forever. So let's say that a president is serving, and their term is their first term is about to come to an end. So when that term is about to come to an end somewhere here, they're gonna print money because there's corruption. Okay, they're gonna force the central bank to increase money supply, lower interest rate, to kind of to present some kind of false illusion to the electorate that the government is doing a lot, printing money to maybe build some roads, or maybe sometimes pure corruption, just buying votes. Corruption, straight up. This happens in some countries. Or they may print money, lower interest rate to create conditions that the economy is doing well around the time when they're going up for re-election. You see that? So they dump money in the economy. When you dump money in the economy, that's expansionary. The economy looks good around that time. So that is so then eventually, once they do that, inflation is gonna go up, because when you print money, we've learned in this class that it brings inflation. And then once they get elected, and then faced with higher inflation, and then they try to enact anti-inflationary, policies. So the central bank has to be forced to enact, to cut money supply, increase interest rate, then inflation comes down. And then you go to the next election cycle, they do the same thing. Okay, so you can limit predicting inflation in developing countries, especially countries that are run by dictators, is very easy. All you gotta do, you need to tie their political business cycles to the money supply growth and inflationary dynamics in their economies. So political business cycles has a whole lot to do with what? Printing money in some of those countries. We don't want that here in the United States. That's why we want our Federal Reserve to be as independent as much as possible from what? From politicians. So that politicians do not insert any pressures Okay, if you're the president of the United States going up for re-election, you don't force the central bank to print money, to dump it in the economy, so that the economy looks good to American voters. By the time you're going up for re-election, and then, we don't do that, but it happens somewhere. So that's what I'm talking about. If you insert political pressure on the central bank, you're going to bring this what? Inflationary bias to monetary policy. And once inflation becomes predictable, where you really know that, oh, I know the money supply is going to go up when they're going out for re-election, that's going to bring inflation. So, we don't want that kind of, we don't want it to be so predictable that the market knows that what is going to happen. Okay. So that is inflationary bias in monetary policy that I'm talking about. That's the strongest argument. The case again is independence. People who don't like the Fed, there's going to be the Fed people who are going to don't like what the Fed is doing. They're going to argue that the Federal Reserve is run by these a few elite groups, like economists, like the 12-member bodies, which make decisions on interest rate. They vote on interest rate every month and a half. They meet 8 times. They're going to argue that this is contrary to our democratic norms. We cannot allow interest rate to be determined by only 14 elite economists or highly trained economists and financial professionals who serve as members of the Federal Open Market Committee, because they think this is going to be, interest rate will affect all the lives of all of 340 million Americans. Okay, why don't we let politicians who put it on a vote? But that kind of argument is self-defeating, because we know politicians. Let me tell you, because if politicians are representing a broad, whatever of American electorate, like in Congress, because Congress, they come from every corner of the United States, and you want us to do monetary policy by putting to a congressional vote. That's not going to work very well, because we know that for the most part, politicians in Congress, and most of them are not economists. They're smart lawyers. Some of them might not have taken Econ 101. You're going to be surprised. So how can we trust them with making major economic decisions, like decisions on interest rate, when we know that politicians are smart lawyers in their right, but they may not be economists? We rather leave that decision with highly trained economists who understand the technicality, the ramification of raising or decreasing interest rate on economic activity, not somebody who is not a trained economist, like congresswoman or a congressman, man from some district, making this on interest rate. We don't want that. So that's what I'm saying. This argument it kind of falls on its face, but people who don't like what the Fed does, they're going to say the Fed is undemocratic because only very few people make decisions which end up affecting the lives of all Americans. The counter argument is you cannot what? Politicians are already subject to what we call the principal agent problems. How many times when you say principal agent problem, politicians are our agents. We, the electorate, are the principals. So when we elect politicians and send them to Washington, D.C., when they're campaigning, they promise like heaven on earth. Oh, we're going to build this road, we're going to build that hospital, we're going to make these schools look great, we're going to pay teachers well, those kind of stuff, pay doctors well. And then when we elect them and send them to Washington, D.C., they're going to answer to big oil, big corporations that gave them campaign contribution. That's what it is. That's a sad thing. So we already have a problem. There's a tension between American electorate and their politicians. That politicians we elect and send, who are our agents, don't typically do what the electorate asks them to do or what they promise they're going to do. So if that is the case, are we going to if we add again another burden on making politicians vote on monetary policy, then the principal agent problem even is going to become worse. Okay. So I talked about that. We can expand on this. Political business side could use, and then also like the Federal Reserve could be used to facilitate treasury financing of large budgetary deficit, what we call policy accommodation. I'm going to talk about that later too. Okay. And then too important to leave politicians. The principal agent, I talked about that, is worse for politicians. So you cannot trust them with that. Yeah. But here's some of the argument against the Fed. People who think the Fed is undemocratic, the Fed is unaccountable, that is difficult to coordinate fiscal and monetary policy anyways, and the Fed has not used its independence successfully. They were going to throw some. We know the Fed has been successful as economists, but there's some politicians who might say, well, we don't like what the Fed is doing, and they're going to label some, bring some arguments against what they think the Fed is doing. So you can go back in time when sometimes politicians actually cross heads with the Fed. We know that recent attacks by the president of the United States on the that has been there, but that is not. You go back in time during President Lyndon Johnson, Richard Nixon, they have always tried to influence the Federal Reserve on a lot of presidents, even during the Clinton administration. Treasury Secretary Robert Rubin established a doctrine that the independence of the Fed should be respected by having the president not comment on Fed policies, which was adopted by George W. Bush and President Obama. But then when that kind of flew away when President Trump became president, we see from time to time President Trump commenting on what the Fed is doing, criticizing the chair of the Fed and those kind of stuff. But this is not new. This has happened in the past as well. Okay. So I told you that the theory of bureaucratic behavior, you can skip this slide because you need to talk about public policy, which we not talked about the theory of altruism, so you're going to skip slides 34 and 35, and that's not going to be part of the, I'm not going to test you on it. Okay. Then we're going to go straight to the structure and independence of the European Central Bank. Okay. What about the ECB? The European Central Bank was formed in 1999. It was patterned after the Fed. When they formed the ECB, this bank in Europe that print this currency called the euro, okay, they made sure that it was the institutional setup of the ECB mimic almost what the Fed did. But they just call certain things differently. Okay, like for example, central banks from each country now play. Remember, before 1999, every country in Europe had their own currency. The Germans used to have their German Deutschmark. The French people used to have their French francs, the Swiss francs. You know that every country. But when they formed this central bank, this group of European countries, they came together and said, "Oh, we need one currency, okay, called the euro." So they needed a central bank that would administer the printing of that new currency. That's when the ECB was began in 1999. Okay, so now, because now these countries came together and started one single bank to print one currency, that means there are regional central banks. Like Germany used to have its own central bank called the Bundesbank that used to print the German Deutschmark, the Bank of France. Now those banks now serve as the regional banks for the U.S. central, the U.S. banks that I talked about, the 12 district branches. They now serve as the regional branches of the ECB, similar to the U.S. regional banks, like the Federal Reserve Bank of Boston. That's similar. And then they also have what they call an executive board. So instead of calling it a board of governors, we have 7 board of governors who sit in Washington, D.C. The European Central Bank have an executive board. That executive board has a president, a vice president, and 4 other members. Okay, so they are what? They are 6 members. In America, we have 7 board of governors. They have 6 executive board members. Okay, and then the terms are 8-year non-renewable terms. That's a little bit of cosmetic difference. For us, the board of governors each serve 14-year non-renewable term. For them, they serve what? 8-year non-renewable term. So see, they pattern it after the Federal Reserve. And then the other thing that they have in Europe is what they call the Governing Council of the ECB. The Governing Council of the European Central Bank plays similar role as the Fed, similar role as the Federal Reserve, Federal Open Market Committee, similar role as the FOMC, which I talked about, our Federal Open Market Committee here. For them, they call theirs the Governing Council. And then, so there are some of the difference between the European Central Bank system of central banks and the Federal Reserve system. National central banks control their own budgets in Europe and the budget of the ECB. In the United States, it's the opposite. The Board of Governors control the budget of the district branches of the Fed. And then monetary policies, operations are not centralized in Europe. They're more decentralized. Okay. And then the European Central Bank does not regulate, supervise, and regulate banks in what? In Europe. They leave the issues of regulation to individual member countries. Like France would, come up with their own regulatory or supervision policies on banks in France. Okay. In America, the Federal Reserve supervises and regulates all private banks in the United States, which is not the case with this ECB. So those are a few cosmetic differences. So here's a governing council, which is similar to the FOMC. Our FOMC here, Federal Open Market Committee, they meet about 8 times in a year in Washington, D.C. The governing council, that plays similar role as our FOMC, they meet 12 times. They meet every month in the headquarters in Frankfurt, Germany. Every month. So 12 meetings in a year. And then our FOMC has got 12 members, remember? 7 board of governors. We talked about that earlier. And 5 other, the New York Fed president and 4 other presidents. They have 19 national central bank heads and 6 executive board. So those are membership to 25 members. And operation is by consensus. Everybody needs to agree on an issue. Otherwise, they're going to compromise until everybody votes on a consensus basis. Okay. The ECB also announced the target rate and takes questions from the media on inflation and other issues. And then to stay at a manageable size as new countries join the European system of central banks, the governing council will be probably on a system of rotation. Okay. Or they could add new members. Okay. So how independent is the European Central Bank? We said that the Federal Reserve was very independent. So here's what I need to tell you. Before, you remember the ECB was created in what? Created in 1999. That's when this group of countries in Europe is a very recent central bank. That's when this group started printing this currency called the euro. So before the ECB was created, European Central Bank, okay, by the head of the ECB is called Christine Lagarde. She used to be the former French finance minister. Then she became the head of the IMF, International Monetary Fund. And then after serving at the IMF in Washington, D.C., she went back. She's now the head of the ECB. So before the ECB was created in 1999, the Federal Reserve used to be the most independent central bank. Okay? But now, the ECB is now the most independent central bank, more independent than the Fed. It's the most independent central bank in the Europe, followed by the Fed. The Fed used to be the most independent central bank in the world, but now the ECB is. Members of the executive board have long terms, determine their own budget, less goal independent price. So you can look at it. So one of the things that makes the ECB very independent is the charter of the ECB that formed the ECB cannot be changed by legislation. It's only by revision of the Maastricht Treaty. If you read about the history of Europe, the European Union, there's what we call the Maastricht Treaty, which is a very rigid treaty in Europe that you cannot just change. Politicians in Europe just voting to change that type of treaties. Meaning that politicians cannot change the charter that created the ECB just at will, because it was formed revision through the Maastricht Treaty, which is one of the most rigid treaties in Europe. And then the structure and independence of other central banks, like Bank of Canada, essentially controls monetary policy, but they're not very independent, just like the central bank. Bank of England has some instrument independence. Bank of Japan recently gained more independence. The trend, but what we see, the general trend for most central banks around the world, they are all moving towards greater independence. They've realized that they need to be independent. So this is the end of this chapter. So this chapter is very, I kind of went through it a little bit fast, but I should have given you as a reading chapter, but it gives you an overview of the institutional setup. You guys need to know that, just like you want to read about the US government, knowing about what Congress does, what the judicial branch does, what the executive branch does. It's equally important as an American to be informed about US central bank, because central banks make decisions that influence your livelihood, like they make decisions on interest rates. So, but before you understand even what the Fed does, which we're going to start doing next, in the next recording, the next chapter that I'm going to do, you need to know what the Fed is all about. What's the institutional setup of the Fed? That's exactly what we did today. So anyway, thank you so much. I will upload these videos at Canvas, and please make sure you're watching them. We'll talk soon. Bye-bye.